Welcome to Lithium-ion Rocks, Season 1, Episode 7, Like a Rockwood Lithium. We have two guests today. One is a man that one of the world's leading lithium experts has said you should listen to everything he says, Gerrit Lithium Fuelling. We also have Tim McKenna, a former colleague of Gerrit's, who was the VP of Business Development and Investor and Government Relations at Rockwood, before taking a similar role at Lithium X through early last year, and has recently joined Piedmont Lithium in that same government and investor and public relations role. We'd like to hear, Gerrit, a bit about your background. You are ex-Rockwood, and you were based in Asia, I understand, responsible for over $200 million in revenue at Rockwood, up through 2015, which was a number of months after Albemarle, acquired the business. So why don't you tell us just a little bit more about your background, what you're doing? I know you're an independent consultant and you do expert calls with hedge funds and consult to companies, et cetera, but give us a little bit more color on that, and then we'll go into lithium-specific discussion.
A mining engineer, been working for Rockwood and its predecessor Chemetall for 28 years, setting up the lithium business in Asia. At the end of my career with the company in Rockwood, I've been in charge of the Asian business again from 2011 to 2015, and with the task to redirect the business setup from technical grade applications towards battery grade, towards all the battery business.
Albemarle, how you view their business at the time of the acquisition and how you view the strategy implemented since then?
The last 2 years, or the last year and a half and two, they have adopted basically the strategy we have started at Rockwood. So when we set up the company to grow in the lithium business, anticipating the electric vehicle markets, and this was in 2010 to 2011, the task was always to acquire additional resources like talent, which we did. So in the beginning not successful, so at the end we only ended up with 50%. But also with a plan to acquire further resources. Because if you are in an emerging market and you need to grow over the long run, 5, 10, 15 years, you need additional resources being able to be developed later on so that you can grow. And if you only have the Atacama, or just a single mine like, let's say, Pilbara, then you may extend the production in that single mine, but you cannot really grow according to what the market is doing, so 20-30% per year. And I think Albemarle is pursuing the strategy well. Whether Wodgina is the right acquisition is a different question, but it fits into a long-term strategy that you need additional resources. SQM, so they also diversified. Okay, they gave up the LAC brine project in Argentina, but they diversified into Kidman, Mount Holland project. And Ganfeng is also acquiring, or maybe with a different, on a different path, additional resources by offtake agreements, but also by acquiring stakes in those projects. So all the three are basically diversifying their resource. Tianqi, in my opinion, does not fit well into this, because the acquisition, in my opinion, of a percentage of SQM without having say and no access to the product, and in that sense, doesn't make too much sense to me. Livent is restricted. So if you only have the operation at Hombre Muerto in Argentina, the growth is limited. So they can maybe double the production and that's it. So they will have to acquire further resources. I think you have mentioned this, Howard, in one of your podcasts.
Your thoughts on one of the biggest growth areas, which has been Argentina. Your thoughts on brines there?
Whether it's brine or whether it's hard rock. So lithium, first of all, is a chemical business. So we are not talking about a typical mining business. You have to make sure that you manage your brine operations in a way that constancy is the case, so that you get a constant input into your conversion plant. For sure, when Cyprus was at that time in the 70s started to evaluate the brine operations, aside from the one they had in Nevada, which is called Silver Peak, they went to South America and basically had a look at all those locations. And finally, they decided they took a decision to buy these lands where Albemarle these days is operating. So this plot or this resource over there belongs to Albemarle. It's not like SQM rented or leased. And they did it on purpose. They did it on a chemical purpose. So this operation there yields a brine which is, in parentheses, relatively easy to process. And the whole evaporation process is a concentration process, is basically a chemical purification as well. And what you do is you get rid of a lot of sodium chloride, magnesium chloride, and all type of other impurities. And at the end of the day, 18 months or something, you have a 6% concentrate, which you are treating in the plant. In Argentina, due to the altitudes and the weather patterns, you don't reach 6%, maybe 1%. And this means you have less time and less chances to get certain impurities out. And you have to do this in the chemical conversion plant. And this can't be, if remember, maybe these days it's not so much emphasized anymore, but in the past years, 3, 4, 5 years, all these junior miners came up and stipulating, we can do it cheaper than the guys in the Atacama. I mean, this is utter nonsense. That would mean that the incumbents, be it SQM or Foot, Rockwood, now Albemarle, would be idiots and wouldn't know what they do. No, that's not that simple. It does not mean that you can't operate in Argentina, but if you want to do it well, and I think the technical process is well founded. So they went to Hombre Muerto and did not copy the Atacama technology, but develop a new technology which yields a good product. And they did it on purpose because they knew that you can't paste and copy what you do in the Atacama. And if you do this, you will have difficulties in getting a right product. And at the end of the day, Argentina will be more expensive, maybe on the same range, probably depends on Salar, as you will be with hard rock from spodumene. But okay, the cost comparison here depends a bit on whether you are integrated or not, in the case of hard rock. So it's not either or, good or bad. It's, you need Argentina anyway, but they will have a different cost perspective. On the industry cost curve, everybody believes he's on the lowest end. We are in an emerging market, and if we think that the market can grow to, assuming 2030, 2035, the market can grow to 1 million or 2 million. You need all of these projects to be successful, even those which are at the very right of the industry cost curve, so having costs of $9 to $10, which is probably the case for lepidolite in China, are more difficult to process, and not only the low-cost ones, which are moving in the range of $4, $5, $6, $7 in operating costs or cash costs. It's not this or that, and I think there has been a bit of confusion in the past of junior miners pushing too much a story which at the end of the day is not consistent with the reality they face.
The reason for investing in lithium, I guess, has always been if demand is so high and it exceeds supply growth, then the marginal cost of production will be on the right-hand side of the cost curve. And if you can successfully produce on the left-hand side, then there's a spectacular EBITDA margin to be earned. I guess the trick is, as you say, is sifting the chaff from the wheat to decide who will fall into that left-hand side realistically.
Yeah, but if you are on the left-hand side, that's what we explained our customers. So when I remember well, when 4 or 5 years ago I went with the price increases, the first ones we did in 2012 or 2011, no? And customers said, your margins are way too high because they saw the published industry cost curves, which put us at, I don't know, $2 or $3 or something, and then the prices went up to $6. Oh, too much margin. In Korea, you can imagine these guys, no? And I said, yeah, but we need these margins in order to keep developing and financing new investments. If you don't have these margins, and I think the minimum you need is 20% EBIT margin. I'm not talking EBITDA margin, but EBIT margin. 20% is the minimum you need in order to keep growing. If you don't have these margins, how are you going to finance it? By debt. Nobody's giving you that money. So this was difficult to explain to cathode manufacturers or battery manufacturers at that time. I think slowly people start to understand that without proper margins, you won't do this. Of course, when you go down the timeline, then the resources with those big high margins, of course, are attractive. Because you can really make money. No? This always considers that finally you reach saturation of the market, and then, of course, those guys on the left side are making the biggest money.
In Chile, you've got enormous reserves, but production just not marrying that. Can you talk a little bit about the reality between the reserves and what's actually possible to produce in Chile?
SQM can certainly produce the numbers they have published. So technically 180,000 tons for them is not an issue from the pumping permits. Yeah, so they have, 1,500, 1,700 liters per second pumping permits, and this is enough. They would have rearranged the run or reading of their ponds, and on top of this have to build the conversion plant. That's a different story, but the reserve is big, but the output, you can't increase the pumping rate endlessly because you would dry out the reservoir. Each of these reservoirs, due to the capillary forces, has a certain flow rate, and if you exceed this, you dry it out, and once it's dry, it's not going to refill again. That is different from hard rock, where you can go and accelerate your output. You put another concentrator, and you take off the overburden and dig a bit faster. This is in brine operations not possible, so there is a limit to that. And this will be the case also in Argentina or in Bolivia if Bolivia ever comes to production. In addition to this, you have to monitor, this came to the freshwater and then the lakes around, so the other things, monitoring wells on aquifers so that you don't damage freshwater reservoirs which are needed by people living there. So this might be less of an issue in some parts of Argentina. But at the end of the day, they face the same issues in pumping with the like in the Atacama. On top of this, you have to make sure that, and that's going to be interesting if you go to areas where 2 companies or 3 companies share or are sitting on the same salt lake or salar. You have to make sure that you don't. That you have no interferences on each other, like in the oil industry. Yeah? So you have oil fields here and there, and companies digging from different sides. You have to make sure that you don't infringe the other guy's rights. So it's going to be interesting to see whether and how this works on the long run. But there is a limit to this, no? To the maximum output versus the total reservoir.
In response to your comment that even high cost $9, $10 lepidolite projects might need to get built to meet this supply, I've understood that it's not such a steep cost curve anymore. It's more flat, certainly with Chilean royalties, but also you're suggesting Argentine assets are higher cost. If the world needs all of these projects, it sounds like you're saying, they're going to be higher CapEx than the juniors are saying, and they're probably going to be higher OpEx, but nevertheless, they need to get built. Is that a fair assessment?
Yes, okay. It is. It's a simple math. I mean, if you take the potential expansion in Atacama and all the low-cost things, you won't end up at the numbers you need.
And you're saying you need at least 20% EBIT margins. I think I saw in one of your LinkedIn posts suggesting a minimum of 30% from an EBITDA perspective. The Albemarle Investor Day 2 years ago, I asked both Luke Kissam there and John Mitchell, who was there at the time, how they assess projects. And they said, I think it was John Mitchell who said, something needs a 20-year mine life at 20,000 tons. It's kind of like in the gold business, if you're a million ounces, 100,000 ounces for 10 years, that's a project threshold as a starting point worth doing. Do you agree with that?
I agree with that. Albemarle, or their predecessor Food, they never started with 20,000 tons. We were building up at that time over decades. I think they started with 5,000 tons, added 10, 15, 20. So it turned out that the maximum feasible to operate is something like 20, 25,000 tons. Plants get larger, the complexity is too high, and the chemical process is difficult to manage. You have to keep this number. So 20,000 tons over 20 years is a good number.
A lot of the feasibility studies we see out of the brines and elsewhere are suggesting kind of $15,000 to $20,000 capital intensity. If you look at Albemarle's purchase and then capital expenditure expectation on Wodgina, the number is $40,000 per ton. And if you assume that Nemaska gets funded and the 375 Canadian is all they need, that would be $33,000 or so capital intensity per hydroxide ton. But what is the new norm?
$40,000 per ton capex does not scare me, because if the life of mine and the OpEx are within a reasonable range and you stay on the industry cost curve, not at the far right, but somewhere in between, why not? So it can be depreciated over time, and as long as the demand line, and we expect this basically with the introduction or further introduction of EVs and penetration rates of EVs up to 2030, 2040. Then, as long as this line is moving to the right, then Albemarle is also able to absorb higher cost. Not only to do this, but to grow and still retain reasonable margins. And those should be basically in line with their fellow lithium guys. So that's my view on those things. And as long as you haven't seen any evaluation of the ore body, or an NI 43-101 or JORC evaluation or something like this, which so far I think hasn't been published, it's relatively difficult to judge whether this Wodgina investment is feasible on the long run. But from the potential on what is known so far, it could be.
That's right. I don't think we're going to see a JORC or 43-101 report, because neither Mineral Resources nor Albemarle has to do that as a larger company. What I do think, though, is that you do have benchmark costs at Pilgangoora, both Altura and Pilbara and Mount Marion, and the experience that Mineral Resources has there. So, I mean, if they could get a 300, 350, to be conservative, spodumene production cost, that's reasonably predictable. The cost of the chemical plant up in the Pilbara compared to Kemerton or Kwinana is another story, but it's likely to be higher cost in my opinion. Going back to the earlier segment where we said 20,000 tons for 20 years as a viable project, but we didn't really discuss, capital intensity for a project that size versus a project Wodgina size. So would you feel comfortable with a $40,000 per ton capital intensity, 20,000 ton, 20-year mine life project?
Why not? So prices will have to be in the range of maybe between $12 and $16, and probably it's going to be on the higher side, so on the $15, $16, $17 range. And in that case, even if you have higher capex and higher opex, you still can retain your what we said earlier, your EBIT margins or EBITDA margin of 20, 30%, which are required to keep investing further.
Gerrit, I think you just made major news there with a long-term price forecast in potentially with a $15 to $17 range. Just want to clarify: is that that's quite a bit higher than some others? Do you believe that that's likely?
If you have a range from 12 to 16, and you go on the timeline, you have to phase in step by step higher cost operations. Then this range is going to move has to move to a higher price. It's probably not going to jump unless you have a shortage or a very, very tight market. But I believe that with the phasing in of higher OPEX and larger CAPEX projects, that you will see prices moving up to that range. So when I say between 12 and 15 or 12 and 16, this is a range where you will see which can develop in 5 to 10 years maybe.
If you're a junior company with a 50 million, 100 million market cap and you're speaking to an investor and they're saying, well, how are you going to finance this 20,000 ton, 20-year mine life project if it's costing you $20,000 or $25,000 capital intensity per ton? Investors need to kind of understand the world needs these tons. It's going to be higher cost, CapEx, higher OpEx potentially, but nevertheless, it's still going to be a very economic project, and they should be, one, funding them, and two, pricing the equity in the market at an appropriate valuation to get it funded.
I think we have to see this from the perspective of the end user, so the OEMs. They must pull out, whatever it costs, electric cars in order to avoid penalties when not matching certain environmental standards emissions. It's going to cost them money, at least in Europe. The question is how much that is. If you have a plan to churn out by 2025 like 1 million cars or 2 million cars or whatever, you have to make sure you get your material. And what happens is that the car industry is putting tens of billions into developing new models, which are the first ones going to hit the market in 2020. Their suppliers, the battery guys, are setting up gigafactory after gigafactory and increasing the numbers. And we are talking about whether it makes sense to invest or not in resources. At the end of the day, these numbers have to match somewhat. I think there is a bit of a disconnect. Currently, there is not enough investment, and considering the timelines, you need to start now.
We are very privileged to have today Tim McKenna, a very long-time Rockwood senior executive who recently has been appointed head of government and investor and public relations for Piedmont Lithium after an 18-month stint in a similar role at Lithium X. Welcome, Tim.
Good to be here, Howard. Good to be talking to Rodney as well. Happy St. Patrick's Day, happy Purim, and happy St. Joseph's Day, and anything else that's being celebrated in the New York area.
Yeah, thanks very much on that. Tim is based in New Jersey, and before we got on the podcast, we were talking about our festivities, both Irish and Purim, and his heritage as part Italian as well. Albemarle is the biggest lithium company in the world. Why don't you just talk about your background there, the history, when it was Rockwood, when it was owned by KKR, their foray from Chile and then into Greenbushes in Australia, and we'll start with that and continue onwards from there.
Rockwood was started around, I think, 2002 by KKR. KKR bought the specialty chemicals business of, I think it was Degoose at the time. In 2004, KKR and Seifi Gashemi, who was running Rockwood at the time and ran it all through its successful run, and then the company called Chemetall, which Chemetall was two pieces: lithium, the largest lithium operation in the world, and a surface treatment chemicals business. To Seifi's credit, he understood how valuable the lithium business could be. It was fairly obvious just from looking at the profit margins that they made. They had a real lock on the business. Rockwood bought the business in 2000, I think it was 2004, for about 2 billion euros, and significantly increased their revenue from about 1 billion to 3 billion, and then proceeded to go public. Well, in the middle of 2005, that's when they began. I was with the forest products industry for 25 years prior to that, but that's when they began interviewing me, and shortly after the public offering, that's how I joined.
So you were there from 2005 IPO time until around 2015 when they sold to Albemarle?
About 10 years. About 10 years.
I've heard fantastic things about Seifi Gashemi, and he ended up selling at a very high multiple, 14.4 times EBITDA trailing 12 months, to Luke Kissam and Albemarle. Some people said that Albemarle overpaid for that acquisition at the time, and Albemarle's stock fell for about a year or so after that. And actually, you were the one who told me that actually the Rockwood IPO fell in 2005 or so. So it took a little while for it to get its feet. But from 2005 to 2015, Rockwood was a very good investment.
No, it was. I mean, we went public at 20. We dropped pretty precipitously to 2007 to 17, excuse me. But then we started to pull back. We pulled back very strongly until 2009. The meltdown period, and then came back strongly after that. Albemarle had tried around, as lithium started to get a lot of attention around, I'd say 2013 or so. Albemarle was announcing that it was going to try to extract lithium from some of the brines it used for its bromine operation, and it was not a successful effort as far as I understand, and that's when Albemarle and Rockwood started to talk.
Interesting. So Albemarle tried to get in the lithium business through their Magnolia project in Arkansas, decided it was too difficult, but then proceeded to make a $6.2 billion acquisition of Rockwood, which was at a price of about $85, 4 times higher than the $20 IPO. And that deal was half cash from Albemarle and half shares. So if you were a shareholder, took your cash, and then held on to your Albemarle shares, which was trading at about $70 at the time, for 3.5 years to February of last year, you would have doubled your money. So overall, a good move for anyone involved in the lithium space, both on the Rockwood and Albemarle side. I've been on the record as being an advocate for Albemarle and thinking that those who are saying Mineral Resources might be too an expensive acquisition, just pointing back to what they were saying on Rockwood. So I'm optimistic about that.
When Rockwood bought the lithium business, we immediately began focusing on promoting the lithium business as the best, as a tremendous investment, and getting people to understand long term. Because at the time Rockwood went public, it had a collection of something like 7 unrelated specialty chemical businesses, and it was Seifi's plan to expand lithium and expand 1 or 2 of the others and divest of the others, which he did over time. By the time he sold Rockwood to Albemarle, it only consisted of 2 businesses: surface treatment chemicals and lithium, which had expanded dramatically. At the time, we were in the early in the 2000s, and when we were in the heart of the business, we had the lowest cost lithium operation in the world in the Salar de Atacama. but we understood that we needed more over time. For the entire time that we were at Rockwood, with the exception of the 2009 global financial meltdown, we were not quite short of lithium, but had just enough to supply all our customers. And our perspective was always that, we didn't want to play the spot market. We wanted to be the reliable supplier. And we were working with the Chilean government over time to try to expand our access to lithium. And a big part of my job, besides talking to investors, was to try to build up better relations. We thought about possibly reopening the Kings Mountain mine, which Albemarle now owns. We got to the point where we knew we could rely on our brine-based lithium operations. And eventually, though, as history goes, we began looking at hard rock, particularly at Greenbushes. And, I would say Albemarle understands exactly what Rockwood understood, 8-9 years ago, that you're going to need more sources of lithium if you're going to supply the kind of battery industry that's in place now. I don't think anybody's going to be able to rely on brine solely, and I think the brine-based producers, as much as I was a promoter of brine-based lithium back in the day at Rockwood, I think there is just not enough of it short term and to medium term to fill global demand.
Tim, we're interested to know a little bit more about the transition of Rockwood out of Chile and into the Western Australian hard rock asset. Can you tell us a bit about that?
We were very confident of the value of our lithium assets in the Salar de Atacama, and I think from an Albemarle standpoint, still, it's a very good asset. And we were certainly confident of the cost structure there. And we had, at the time we started looking at Greenbushes, we had expanded our operation in the States, and we're already starting to expand the operation in Chile, that is, expand the La Negra converting plant. But we had been working for some time with the Chilean government to try to get more rights to use lithium from the desert. I think most people don't know that actually Rockwood, Albemarle, and its predecessors had actually bought the rights for all of the lithium they were using, through the 2000s in the initial deal they made with the Chilean government. They weren't actually paying a royalty. They were paying taxes, but they were not actually paying a royalty. They had paid a royalty up front. Anyway, those discussions with the government stalled for political reasons. The government was into a very difficult election, which is worth exploring on another podcast, but it was a very difficult election and time. And so Seifi, who's, if nothing, and frankly is one of the better strategists, started to look at Greenbushes and understood that a principal holder of Greenbushes stock, Talison stock, was interested in selling. So, to make a long story short, we ended up making a bid for Talison. This was in, I think, 2012. And, we had at the time the advice from the best and smartest Australian lawyers and investment bankers that Australia would never let the Chinese outbid us, and that, well, lo and behold, within maybe 2 days of our bid being finalized, the Chinese came along and outbid us. And I'd say to Rockwood and to Seifi's credit, we decided not to get into a bidding war with them because it just would have gone on and on. So we ended up not buying, but then within probably months, Tianqi and Rockwood were in conversations to perhaps have Rockwood buy an interest in the Taliesin operation, the Greenbushes operation, because Tianqi didn't have enough technological expertise. At least that's the way they presented it to us, to use all of the lithium that was going to come out of that mine. So we ended up buying a 49-point-something% interest in Greenbushes, and that diversified our supply. And we began to talk about a number of other things that we might do to use that material. As everyone knows who's following lithium now, the great advantage of coming out of spodumene is that you can go directly from spodumene to lithium hydroxide. If you're going from brine, as again most people know these days, you have to go from brine to carbonate and then to hydroxide. So if you have a good supply of spodumene, which certainly Greenbushes has in Western Australia, you can produce lithium hydroxide for a very economical price. And then the other thing that Rockwood understood, Rockwood's lithium operation was two pieces. It was a company called Foot Minerals, which started the Kings Mountain mine, and once back in the 50s was the major producer of the world's lithium. And then it was a company called Chemetall, which ultimately became the name of the business, which was a processor of lithium, and frankly wrote the book on how to process lithium, what to do with it. I still have a copy of that little book, which they used to sell to people, but they certainly understood at the time, these German scientists, that lithium hydroxide was going to be the preferred chemical for the kind of big batteries that Tesla and all produces. So that's basically the history of how Rockwood got into that deal. And then within a year of us buying that, Albemarle was in talks, which ultimately led to the deal of Albemarle buying Rockwood.
And then if we shift across to the States, can you speak a little about Silver Peak, some of the other operations?
In 2009, the Obama administration comes along with what they called the American Relief and Recovery Act, something like that, which included a lot of support for supposedly shovel-ready projects to try to kickstart the economy. And one of those grants was money for alternative energy projects, basically, or alternative energy materials. And so Rockwood applied for a grant to basically redo the wells in Silver Peak, as well as build a renewed lithium hydroxide plant in Kings Mountain. And, we were very successful. We got a $28 million grant. It was a matching grant. You had to spend an equal amount. We redid the pond system and wells in Silver Peak, and then built what's now, a very good lithium hydroxide plant in Kings Mountain.
We're looking at, chatting across to the various participants in the industry, and the consensus continues to be that there is a lack of investment in lithium, upstream and downstream, and that the OEMs, for all the targets and the expectations that they're having, they're not going to be reached. So you deal quite a bit in government relations. It would be good to get an idea of how seriously, Capitol Hill is looking at this, the thoughts on SAFE, and whether or not, the necessary changes are going to be made in order to achieve all these grand targets that are being put out there.
In the sort of mid-2000s, let's say 2007 time period, we were doing our best to educate legislators about what lithium actually was and what the potential was for electric vehicles. And we had gotten very active in an organization called Securing America's Future Energy, which is still riding very strong in Washington. It's probably the lead advocacy group in Washington that advocates for secure, reliable, affordable, clean supplies of energy. And it takes the position that, we fight wars around the world and get into all sorts of trouble just to keep the oil flowing. And, we need to look, and I believe this as a citizen, we need to look long term at, how are we going to supply energy for all of the things we use? And one very simple way to reduce the use of petroleum products and use energy more efficiently is to go to electric vehicles. And I think it's becoming evident with what the auto industry is doing, what Tesla has done, what Audi is doing, BMW, and so on, that the industry is going to slowly but surely gravitate to more electric drive technology. And this is not really as much a clean air thing as it takes something like 1/6 the energy to move a car by electricity as it does to move with an internal combustion engine. So we've been heavily involved in that kind of advocacy, as long as and really giving the same message to the investment community.
And in today's modern times, we've got Simon Moores from Benchmark Minerals testifying in front of Senate committees, etc. Do you think that the powers that be are going to listen and realize the position they're in regarding battery, energy vehicle battery metals?
Well, I think they are starting to understand. I mean, certainly the hearing that you referred to, where Simon Moores spoke before the Energy and Natural Resources Committee. First of all, that committee is one of the few well-functioning committees in Washington with a good bipartisan group of people. The senior member is Lisa Murkowski of Alaska, who of course is a friend to the petroleum industry, but actually a very independent woman. People need to remember that a very right-of-center candidate knocked her out of the nomination in the last time she ran for office, and she ran as an independent and still managed to win. Joe Manchin, the Democrat from West Virginia, is the ranking minority member on the committee, and they are very, very focused on real energy issues because they represent energy states. They're starting to understand, and in my discussions with various legislators who represent North Carolina, they understand there is a real opportunity here, and certainly the legislators who represent the Southeast as well as the Midwest understand that the auto industry, the crucial point where it needs to maintain its competitiveness. I've been talking with people in the State Department on China policy who understand that if the United States does not start to get more active in this area, China, which has been buying up as much lithium as it possibly can, will control that supply and critically threatens to control the supply chain, which I think is the real issue here for the Americans.
I could, if I could just chime in there, because I've had a number of conversations for much of last year. I was very outwardly and vocally trying to get attention to the Tianqi SQM, what I consider China nationalization of the people's lithium of Chile, and to no avail from a U.S. perspective, because I saw SQM as an NYSE listed company and Nutrien as an NYSE listed company. There could be some jurisdiction there, but apart from Senator Manchin and Murkowski, I understand the State Department is very much increasingly attuned to this consideration of China's encroachment on the world's battery materials. And alongside that, I understand there are some interagency discussions. Mike Pence gave a speech last year, and the Department of Defense put out an industrial policy last year highlighting 300 strategic vulnerabilities in America, of which military batteries was one. So, the lithium business in America, I think, started in North Carolina as part of the Manhattan Project, as Gerrit Fuelling called it, but basically for the hydrogen bomb, lithium was necessary. So that spawned, like so many things, something starts with the military and then the civilian applications kind of take over. So the hydrogen bomb application may have been maybe 10% of it, but it spawned, North Carolina's dominance for, some 40 years in the lithium industry. And so it's good to, like, from Simon Moore's first visit 15 months ago to this second one to now the State Department and other arms of the U.S. government, recognizing that there's movement there. At the same time, you see, Donald Trump tweeting today to, after having a conversation with Mary Barra to, reopen the Lordstown, Ohio plant. And he hasn't been a huge fan of the overall EV thematic, or he's more been pro-coal. At the same time, you have states like California and New York and others, just going ahead with, the more majority, European, global sentiment toward this. So if we could just conclude, I believe some sort of a trade deal is relatively imminent. It's in both China and Trump's interest, politically, to do that. But do you have any read on the electric car and the battery storage business?
The organization SAFE that I mentioned has a very strong backing by retired generals and people in the Defense Department who understand that energy is it's really the foundation of any modern economy, any industrial economy. And so they're very concerned, and their supporters are very concerned about secure, reliable, clean supplies, sustainable supplies of energy, and that includes alternative energy. The best that I understand from the State Department, as well as others in the Department of Defense, is what they're looking to do is to try to see if there are partnerships we can make with other countries outside of China, whether it be Canada, Chile, Argentina, Eastern European countries that have access to all of the various materials that might be used in a battery or in an alternative energy application, and see if we can do something to try to support their efforts, make partnership efforts that would allow other parts of the supply chain to grow. The final point is that most people in Washington understand that there are tons of tax preferences and tax expenditures that are given to industries all across the board. The energy industry, the oil industry is a very big beneficiary, as is the agricultural industry. Those people who say we shouldn't give any money to industry, they're kind of missing the point, because money already does go to industry. In an ideal world, we would have everything, those of us who favor free enterprise would have, everything go, through the free enterprise system. But that's not the way, our modern government works. It's not the way that Europe works, and it sure as hell isn't the way China works. What we need is sensible policies. What we need, is instead of trying to attack these things when there's a crisis, and this is what SAFE's activity is, and this is what people like Simon Moore's advocate, and this is what the Senate Energy Committee thinks of, is let's look at long-term policies that would underpin, a sound energy economy.
That's great. Thank you very much, Tim. I will be looking forward to your bringing me some corned beef and cabbage, and in return, I'll bring you some Hummintashen.
That's great. And by the way, I'm sure in where you are in Queens, there's probably some nice Italian bakery that will have something for St. Joseph's Day tomorrow. So they have terrific pastry. If you're in good shape, your waistline can handle them. So.
They certainly do. One of my favorite lines in one of the Godfather movies was after one of their hits. I forget which one. Who said, like, "Don't forget the cannolis in the car."
Yeah, it was the famous line is, "Leave the gun, take the cannolis."
And we'll leave it at that. Thanks a lot, Tim. Take care. Lithium-ion Rocks, Lithium-ion Bull, and through our respective LinkedIn and Twitter posts, Rodney and I may share with our audience some rationale for a stock for which we have conviction, to own or not to own. If you agree or disagree with and act on or against the rationale of anything said or written in this or any other Lithium-ion Rocks or Lithium-ion Bull, that's your free choice. But to be clear, what you are listening to or reading is not investment advice and may not be unbiased. It should not be construed as an investment recommendation to buy or sell any security. Rodney and I are not registered investment advisors nor broker-dealers. Please visit libull.com for further disclaimers.